First thing is for emergencies. You want to keep your savings so that if there's emergencies, then you have money to help yourself. Usually as advisors, we say that you keep at least 6 months of your expenses as emergencies. So if anything happens to your job, at least for the next 6 months, you don't have to run helter skelter. You're sure that that will help you till you get another job. The second thing is short-term goals. So anything less than 3 years is called a short-term goal. I want to buy a car next year. That's a short-term goal. So those are those things that we call short-term goals. Then we do have the last, which is the long-term goals. Your long-term goals majorly are your retirement plan, saving for the future, and maybe buying a house. Those could be long-term goals. Why do we invest? First, to preserve our purchase power. So we all know that there's inflation. So inflation literally means $1,000 you have today is worth more than $1,000 tomorrow because your money each year devalues. And so you don't want to put your money in a savings account which will not even match inflation. The second thing is power of compounding. So because the interest you earn on your investments will grow and multiply into more interest, and that way it compounds your interest over time. Then the third one is potential market gains. Yeah, if you're being the kind of person that do stock trading like me, you know the advantage over the last couple of months, people had made millions. You want the market gains because if you buy stock $10 2 years ago and the stock is worth $100 right now, you've made over 1,000%. So that's what we meant by potential market gains. And then the next thing I want to go about is to explain the types of investments we have. The first one is called annuity. This is usually common to people who are retiring. So you have some chunk of funds that um, before retiring, and then you can put it into an annuity, which will pay you certain amount every month or yearly, depending on what you select. And then it goes. It's usually common with insurance people, though. The second one is bonds. So a bonds really is a certificate you receive for a loan. So let's say a company decides to sell bonds. So you buy the bonds, and based on the fact that they're taking your money, they give you interest every month or every year, depending on what it is. And then at the end of the term, they return back your principal to you. The third one we have is an exchange traded fund. So this is not so common. It's a type of it's an investment funds that holds stocks, commodities, and bonds. So it's not so common, but it's a fantastic one because compared to mutual funds where you pay costs, in these the costs are lower. So that's why the exchange traded fund is a bit better for people. Then the next is the guarantee investment certificate, which most of us are aware. Back in Nigeria, we call it fixed deposit. So it's just holding your money for a certain 14 months, could be 16 months, it could be 1 year, 2 years, and we do have two types of that. We have the traditional GIC and the market GIC, market growth GIC. I will explain that later. So, and then the fourth, which we're all aware about, is a mutual funds. What is a mutual fund? It's just about people accumulating money together, and then a manager of that funds will use it to invest into stocks, bonds, options, money markets, and name it, all the securities. And at the end of the year, whatever interest they make, they share it over the number of people per the percentage of stocks you have. Then we did the fifth is the segregated funds. A segregated fund is basically a pool investment fund, much like the mutual funds, and also done by the insurance company. And then the final one will be the sixth one is the stocks. So a stock basically is you buying a share of a company. So back in Nigeria, we call it shares. It's more like stocks. So you're buying the shares or equities of those companies, and you make either capital gain or interest gain based on what kind of stocks it is. And then the final one is Treasury Bills. I'm sure most of us are aware that about that in Nigeria. It used to be one of the big investment in Nigeria, but right in Canada, it's actually low. So you don't make so much income on it. It's short term and it has very low risk though. this chart just shows, just to explain basically why you have to do this or why you don't have to do that. So the four major ones are what I listed here. We have the savings account. The savings accounts are very convenient, accessible, but they give you the lowest growth potential. So you don't want to put your Rrsps, your TFSAs in savings account. Why? Because they give you the lowest growth potential. I mean, I've seen lots of people who put their TFSA in savings account and I smile. That's not it. You want to maximize the effect of having a tax-free savings account, and you don't want to put your money into something that won't generate growth. If you look at the 10 years annualized returns just below that, you see for savings account, it pays you 0.01. And I've also put what the average inflation is right now in Canada. The average inflation is 1.59. So meaning that if you have $1,000 in your savings account, you're only earning 0.01. But you're losing value of your money 1.59% every year. So that means you are losing money. Most people will say, oh, my money is safe, at least it's not fluctuating. No, you're losing money because your money is not even catching up to the minimum inflation. So you're losing money. So, but if you need the money next week, you need it in a month's time, a year's time, then it might be the best option for you because you don't want your money to fluctuate. The second one is what we call the Guaranteed Investment Certificates, which is GICs. The returns of GICs had gone down drastically at the moment. I think the highest you probably will get will be about 1.2 or 3%, which makes me think too, because you're not catching up with inflation. Is it the right investment for you? No, if you're saving towards long term. So having a GIC in your Rrsps, which if your retirement is over 10 years from now, it's not the right decision. You're losing money, whether you like it or not, because your money is depreciating each year and you still have to look about your goal. Will the GIC, the returns on the GIC help you make your goal? No. A GIC will give you 1% a year. What's 1%? When you can make 15% in other investment, depending on your risk criteria or how much you can risk your investments. The third one is what we call the market growth GICs. So the market growth GICs are not so common. I forgot to take out the TD part off. So I work with TD, but I'm not allowed to talk about TD. So it's a general discussion I'm talking about today. So for market growth GICs, your principal is guaranteed as well. But what the banks do at the background is we put it into some market exposures. So we invest it into options and other investments so that we can get more growth. Now we do cap up your maximum you can get. So let's say the investment at the end of the year makes 15%. The bank will cap up your own returns to 8%. But the question I ask people is, why not just make the 15% by getting your own exposure into the markets? But some people are scared of risk. But I would recommend this than doing the normal GIC because this gives you your principal is guaranteed. You do have a minimum guaranteed interest and you can make up to a maximum. So the maximum can differ, but at least you have a guaranteed interest and a guaranteed principal. Then the final one, which I love so much, is the mutual funds. So the mutual funds gives you a higher growth potential. Most people run away from this, but the truth is, if you want to make your goal for retirement, this is the best. Or probably education savings too. So if you have Rrsp for your children and you have it in savings or GICs, you might not be in the right place. Well, it depends. If your child will be going to school in 2 years or 3 years, it probably be the best option for you. But if your child has over 5 years in time horizon, then you don't want to keep your Rrsps into a savings or a GICs. And you can see the average on that is doing about 5.51% with the benchmark, which is fantastic compared to any other investment type. Now I'll go into the investment types. The first one I have is a TFSA. A TFSA is just a tax-free savings account. It's registered with the CRA, as we're all aware. And you can have so many types of investments. You can have mutual funds, GIC, stocks, bonds into these investments. Now, you do have a contribution limit into it, because the advantage of a tax-free is if I put $10,000 2 years ago in my tax-free, and this year I've made it's already $15,000. The $5,000 I've made, it's non-taxable. Whereas in any other type of investment or registered accounts or non-registered accounts, you do have to pay taxes on that amount when you take the money out. So it's an advantage. If you don't have a TFSA, you need to go get one. It's I can't start mentioning how much of capital gains I've made on my TFSA. It's a good place to keep your investment if you're the active investor, not just putting it into a savings account. Now, because the CRA doesn't want people to put 1 million in that account and start making money, so the CRA has a cap to what you can put each year. The TFSA started in 2009, and as of 2009 till to date, you can put up to 75,500. That is if you are 18 years at 2009 and you've been in Canada. So you have to be in Canada for you to be able to benefit from this. So each year has their limits. 2019 to 2020, 2019 to 2015 should be there. It's 6,000. And then 2016 to 2019 to 2021 is 6,000. So 6,000 each year. In 2016 to 2018, you can put 5,500. In 2015, 10,000. 2013 to 2014, 5,500. And 2009 to 2012 is 5,000. So you just have to calculate it based on when you've been in Canada and what age you were at that point. If you go into your My CRA account or your notice assessment also, you will see your tax-free contribution limit. So you need to know what your limit is, because if you exceed that limit, CRA is going to charge you 1% every month for the amount you exceed your limit. So you don't want to do that. And the good thing about TFSA is that your limits are carried over. So let's say you've been in Canada since 2016 and you've never contributed. You can start calculating your limit from 2016 to 2021, and you can contribute that at once. The other good thing part is if you take money out of your Rrsps, let's say this year I met my limit of, let's say my limit is 20,000 and I've contributed 20,000 into my limit, which means I cannot contribute anything any longer. If I take $5,000 out of that 20,000, next year I can carry over that 5,000 back with the new limit of the next year. So which is fantastic. So you could work your ways. Like me, when I want to take money out of my TFSA, I take it out like December 30th so that I can recontribute it back in January 1st. That's the kind of thing. And I mentioned over contribution. If you go over your contribution, there will be a 1% charge per every month from the CRA. So you don't want to do that. I've seen people who got bill of 20,000 and 20-something thousand. So you don't want to make that mistake. The next one we have to talk about is the Rrsps. And Rrsp is basically a way of deferring your taxes. So let's say you made an income of 100,000 this year, and or last year, and you put $10,000 into your Rrsp. What happens is the taxes on the 10,000 you already paid will be deferred. And then when you file your taxes, you get a refund from CRA saying that that amount, because you contributed into your Rrsps, will be returned back to you. So you want to make advantage of this, especially if you make more than $50,000. Based on that, you can start calculating. There are several calculators you can use to calculate exactly how much you need to contribute. If you do need a calculator, I can email it to you. Just chat me after this meeting and I can send you a copy of those calculators. So as I said, the Rrsp is a savings plan that's registered with the Canadian government, and saying that too, it has a limit each year. So normally you can contribute up to 18% of your income each year. And this is also carried over from the years before. So if you've worked some years that you did not contribute into your Rrsps, it's carried over. The only difference between these and the TFSA is if you contribute it and take the money out, the limit, you can't recontribute that limit again. it's gone for life. That's the difference majorly. And as I said earlier in the last meetings, the Rrsps could be used for so many things. So you can use it for your home buyer's plan. So if you're buying your first home, you can withdraw up to 35,000 using your Rrsps. And also you can use it for a long-term learning. So if you're going back to school, higher education, you can use the money as well. And you can also contribute to an Rrsp in the name of your spouse. So let's say you've already contributed to your limit and your spouse still has room and our income is not so much. So you can contribute into our limit and you get the benefit, even though the Rrsp belongs to your wife, but you get the advantage to write out that amount you contribute as well. The other good part of the Rrsp is that you can contribute into it 60 days at the end of the calendar year. So let's say you did not contribute last year, you still have till February ending to contribute into your Rrsps, and you can use that either for 2020 or 2021. So if you haven't contributed in Rrsp, this just lets you know that you still have the advantage. If you're not doing this, you need to do it. It helps a lot because that way you can reduce your income. So for somebody like me, what I do is I contribute into my Rrsps, and the refund I get is what I throw into my TFSA. And that way I can use one stone to kill two birds. So you want to make advantage of this. If you want more information about this, you can contact me as well after this because of our time. As I said, you can use it for your Rrsps to buy a new home, and you can use it for education plan as well. This table just shows how it helps majorly. So it says the federal tax rates for 2021, you pay 15% of whatever income on your first 49,000. So let's say you make an income of 60,000. If whatever you contribute into your Rrsp defers your taxes up to an amount, but if you go down to 49,000, what happens is if your taxable your taxable percentage is 20.5%. If you contribute and bring your income to 49,000, what happens is you bring yourself to a lower tax bracket, which will give you a much more bigger refunds. This will show more in people who are on the higher tax bracket. Let's say your income is over 216,000 now, and you put so much money in your Rrsp that brings your taxes to like 26%. That means the other 9%, you get it back as a refund, and which might be big. So those are the advantages of having an Rrsp. It's very important. Just forget about the fact that you can also grow the money, and when it's time to retire, you get so much money to help in your retirement. So it's very, very important to have an Rrsp. This table just shows the difference between the Rrsps and the tax-free account. Basically, it's for Rrsps, contribution can reduce your taxable income and lower tax paid. For TFSA, you can't defer your income. No. So if you contribute into your TFSA or Rrsps, you don't get any tax advantage. For investments can grow up in your Rrsps, tax deferred as well. But when you take out the money, you start paying taxes on it. But depending on your income, because we believe that by the time you retire, your income will have reduced. It's not always the case though, but most times we believe your income will have reduced. And when you're taking the money at that point, you're taking at a lower tax bracket, which will have saved you more money if you had paid the taxes when you were getting the income. You can contribute up to 6,000 annually and carry over any unused contributions in your TFSAs. Tax-free withdrawal. So if you take money out of your TFSAs, it is tax-free. But if you take money out of your Rrsp, as I said, the bank will have to defer some taxes from you. And then at the end of the year, when you file your taxes, that will count as a new income. So let's say you take $10,000 from your Rrsps. Apart from the deferred taxes that the bank will take out from you, at the end of the year, you're going to add 10,000 to your income. And then you will now pay taxes on overall. If there's an excess you paid before, the government will return some back to you, And if it's less, you still pay more taxes on that 10,000. Then I'll go into Rrsp. So an Rrsp is just a fund that, it's an investment account that you set up to fund a child's post-secondary education. So when you put money into your Rrsp, what it does is the government contributes some money as well to you. So we have some of the grants. First one is Canada Education Savings Grant, which is a CESG. And what that does is whatever you contribute up to a maximum, the government will contribute 20%. So the maximum in a year you can put into it is 5,000. And when you do, so 20% of your annual contribution, the government will matches up at most $500 each year. So let's say we say 20%. If you put 200 and let me just get this again. So whatever you contribute each year up to a maximum of 5,000, the government matches $500. So you don't want to contribute more than that. So, and the maximum the government can do throughout the lifespan of the Rrsp is 7,200. So I typically tell people put at least minimum of $210 every month. If you put 210 every month, you get 20% by the government as the CESG. Now, if your income is lower than 45,916, you get an extra additional CESG, which is an extra 20% on the first $500. So if your family income is less than 45,916, you want to maximize the Rrsp so that you can get more money. And if your family income is between 45 and 91,000, you get an extra 10% on the first $500. This is the additional CESG. So it's different from the CESG. The first CESG guarantees 20%. This is an extra depending on your income. If your income is over 91,000, you don't get any additional CESG, but you still get the basic one, which is a 20%. So imagine you're putting money, apart from the growth and the investment, you're getting a free $500, which is 20%. So that means your investment is growing 20% already, even if you put it in a savings account. Now you can then put it into an investment that could give you a basic 10%, 15% each year. And that would help you eventually increase your gains over the years. The other one we have is what we call the Canadian Learning Bond. So this is for low-income people. When you put your when you open a Rrsp account, the government will give you $500 immediately. And that's for people who earn income less than 47,630. You get that. Types of Rrsps. We have the individual Rrsp, the family Rrsp, and group Rrsp. The individual Rrsp is that maybe it's a family of one. You just want to open one for one kid. The family Rrsp is for anybody who believes that they're going to have more than one child. So if you have two children, you want to open a family Rrsp rather than individual. Why the family Rrsp is because let's say your first child gets a scholarship and didn't have to use the money for their tuition while in school. Then the second child can use the whole money. So that's the advantage of having a family Rrsp because any child can use it at that point. And then the group Rrsp are some of those companies that offer the Rrsps. They pull all the money from different people together, invest it, and then when they are going to school, they start paying for that. I do tell people when they go for group Rrsp, you should be careful, read the contract very well. Some of them have very, very funny contracts. Rather just go for your individual Rrsp or family Rrsps. They're about the best. Now for Rrsp, let's talk about the withdrawal rule. So as I said, Rrsp is for your child's education. So if your child decides not to go to school at the end of the day, it doesn't mean you've lost the money. You can still get your money out, but it's advisable for the child to go to school. And if the child doesn't go, the second child can go. But let's say they didn't go to school, for instance, and you need your money. Now it becomes an issue because the government contribution has to go back to government if you take your money out. So you can get your capital out back. The government contribution will have to go back to the government. And then the income you made will be taxable, except you can move it into your Rrsps and then use it in your Rrsps. But I do say, well, if the child still has up to 17, 15 years to decide to go to school before the closure of the Resp. Now you have a limit to what you can put in your Resp though, even though you get benefit from it, but you can only put 50,000 per beneficiary. You don't want to exceed that. Once you reach the 50,000, you cannot put more money into the Rrsps. And I already talked about what happens if they don't use the Rrsps. And then we do have other registered accounts. We have the RPPs, which are like pensions from work. We have the locked-in Rrsps, which means it's an Rsp, but your former employer locked it in because they don't want you to take the money out until retirement. And we have the LIRA, which is just the Alberta equivalent of the LRSPs. After you retire, you have the maximum age of 71 to move your Rrsps into, or your LRSPs into either a LEAF or a RRIF. A RRIF is just a retirement income form that you move your Rrsps into, and it funds your retirement, maybe monthly, quarterlies, or yearly, depending on what you want. Now, let's look at about investment. So I've seen so many people talk about investment, especially with what is going on with the pandemic. People felt, I've seen so many of my customers will come to me, Michael, I lost so much money. I don't want to reinvest. I want to take my cash out. Remember, if your goal is for retirement, it's a long time horizon. You don't have to worry because markets will always fluctuate, whether you like it or not. And this fluctuation is what actually makes our investment grow. If you look at records over the years that the investment declines are the subsequent years after it, the investment go really up. If somebody is invested in something like a Tesla stock right now, a Tesla stock, I have colleagues that bought Tesla stock at 180. Right now, Tesla stock is over $800, which is over 100% increase. So don't worry about those declines. Don't be scared about your money will fluctuate. As long as you have a long-time horizon, you don't have to worry. What has history taught us? So this slide just shows typically how investments have declined over the years and how market had performed. So if look at July 1st, 1987 to November 1, 1987, we had a decline. Markets went down negative 25%. Like you having 1,000 and your investment going to 7,500, everybody will feel like, oh, what? I want to take my money out. But if you take your money out at that time, that's when you suffer the loss. Now look at the result. A year later, it was 14.5%. 5 years later, it was 31.9%. 10 years later, it was 193%. So if you had taken the money out at the point in 87 when the market went down, you'll have lost a lot of money. You've lost a quarter of your investment. But if you have left it, 5 years later, you've made your investment. 10 years later, you've even doubled it. So it's important to understand how investment performs. Investment, there will always be downtowns. There's no way. There will always be. It can never be a straight circle. If you want a straight circle, you put your money in savings and you get 1% each year. For the next 20 years, you're getting 20%. Whereas if you put it in investments with minimal fluctuation, an average investment will do 5 years, 5% for you every year. So if you look at 5% in 10 years, you've made 50%. That's a modest investment. And ahead. Does anyone have any question? Thank you for listening.